Run us through your investment checklist.
At Mirae Asset, the overall investment philosophy is centered around investing in reasonable quality businesses up to a reasonable price. And from a portfolio construction point of view, the approach is to have a well diversified portfolio having representation across sectors. And for stock selection, the approach is to apply certain filters in all the three buckets: selection of business, evaluation of management, and the valuation part. So let me take one by one very quickly. On business selection, the approach is to identify growth-oriented business. India is a growing market, so let's say growth should be double-digit, ideally twice the real GDP growth, or higher the better, obviously. And the character of the growth, as represented by the value added, economic value added, return on capital employed should be high. And management evaluation is the second important factor. It's a bit qualitative, but a lot of emphasis is given to not only see the basic hygiene in the corporate governance related factors, but more importantly to get a perspective in terms of the thought leadership of the management, because leadership and the management also has a large bearing in terms of the wealth creation. And lastly, on the valuation part, while selecting stock, is extremely important that whatever price, the value has to be bigger, more than the price. So there has to be ample margin of safety. So it's a combination of all these factors in terms when you select a stock. As regard to your question that does it vary across large cap or mid caps, it doesn't. The framework of stock selection do not vary. In case of mid caps, the ask rate is slightly higher. You would like to have a higher growth, a better ROCE, so that there is a higher margin of safety. On growth, clearly we would like to see low teens to mid teens sort of growth. ROCE, the house filter is 15% pre-tax. That is the minimum return on capital employed a business should sort of have. And on the valuation part, again, there has to be ample margin of safety. It varies across the character of the business, but generally around 15-20% gap should be there, where the value should be higher than the price. The higher the better in all these sort of cases. But ultimately, I mean, in the important ones are ROCs and the valuation part. We also do DCF valuation while arriving at a business, or sometimes reverse DCF valuation to arrive at the implied growth.
Could you tell us how your philosophy blends into the three schemes offered by Mirae?
So each of the three schemes which you alluded to, which is the emerging blue chip fund, the hybrid fund, and the tax saver, they are in separate categories. So the overall template of stock selection is same across the house, across various products. That doesn't change much. The portfolio construction needs to be seen in terms of which category it is, what is the relevant benchmark. Let me just quickly talk about all the three funds. So emerging blue chip fund is the flagship fund in our large and mid cap space. This will be completing 10 years in the current calendar year, and it's co-managed by my colleague Ankit Jain and myself. And here the approach is to own purely in terms of market capitalization. Roughly about 50% is in the large caps and 50% is in the mid cap. And there can be leeway of about 5-7%. Stock selection philosophy, as I mentioned, is similar. The hybrid fund is in the aggressive hybrid category. So the band of equity is around 70 to 75%. Let me put it, let's say 73 plus minus 2 percentage points. What happens is when the markets correct, we tend to increase by more of equities. One is automatically the equity proportion comes down, but we buy extra and we move towards, let's say, closer to 75%, and the reverse is sort of true. So that's in the hybrid sort of category. The Mirae Asset Tax Saver, which will be completing, by the way, hybrid funds will be completing 5 years after 2 months, and the Tax Saver fund has just completed 4 years. Here it's a multi-cap fund. It is in the ALSS category, so it's absolutely same in terms of the approach or the investment style, except that the benchmark is the 200 stock benchmark, and the fact is there is because in an DDTC there is a 3-year sort of lock-in. So it's a multi-cap fund, just like a normal multi-cap fund, and the approach and the stock selection or portfolio construction, that is similar.
What is the secret of creating alpha in a scheme?
One is, of course, a lot depends in terms of how the research team is, what the sort of processes are. I mean, that is extremely important while selecting a stock. because it's a very relative sort of industry. So to that extent, I think the importance, lot of importance to maintaining, having the processes, maintaining the hygiene of those sort of processes, and the research team and the analysis is extremely sort of paramount. But that said, ultimately alpha is generated through, and at least in our case, has come more from stock selection rather than too much of significant sectoral call. So our active share vis-a-vis sector wide deviation is not significant, and alpha is primarily come from picking up the right stock within a sector.
Which sectors are you currently bullish on?
So banks have higher allocation for few reasons, let's say 3 reasons. One is the fact that we believe that Indian financials in general, many products are under penetrated. So there is a long runway to grow, and particularly the migration of both on the asset and liability side to more private financiers. So that is a very longer term sort of theme. The second reason why we are positive on financials, including corporate banks, is the earnings growth in the near term is driven by banks. If you look at from FY19 base for the next 3 years, almost more than 50% of the delta earnings growth is coming from financials, particularly the turnaround in the corporate banks. And the third reason why financials appear higher in all portfolios is also the fact that the benchmark have a large weight. So because the weights are north of 30 odd percent, it appears to be sort of high. So a combination of all three is what is reflected as significant or the largest overweight in the portfolio.
When it comes to banks, do you have any kind of preferences? Any concerns about valuation?
So there are very many pockets. First of all, I think the what we like is banks which have better ROE and better growth. That is the basic metrics. What has happened is there has been set of banks which have been impacted by corporate NPAs, and there the valuation mean reversion is work in progress. In some cases it has happened, in some cases we think there is a long way to go, and that's where we see larger opportunity. In addition to that, there is a core banking sort of set of companies which have been, even in challenging times, which are much more retail oriented on the asset side, have been doing reasonably well. So that also is a large portion of the portfolio. And by the way, financial these days also include other companies. I mean, these are financial sector related other companies, be it some of the product companies, be it insurance, those sort of names are also there. Key rationale, as I mentioned, is the long runway to grow. The penetration of many of the products is less, number one. Number two, there is a market share shift which is happening. The shift is happening where almost 2/3 or more market is still with government oriented entities, and the private financiers, based on their strength both on liability and the retail franchise, they are able to get market share.
What are the other sectors you are keeping an eye on?
No, in general, we as of now we are seeing opportunities across many sectors. Particularly, we are seeing opportunities in a pocket of markets where the earnings visibility is patchy, but the valuations are extremely attractive. Where earnings growth has been momentarily impaired. Corporate bank is one of them. Telecom is another. Private capex oriented companies are sort of other. Healthcare is another, where the current level of profitability do not necessarily reflect the longer term potential, and market is, because of the polarization, has beaten them, or they have made them much more attractive. So that is clearly one of the pockets. In addition, there is a core portfolio, particularly more skewed towards consumer oriented businesses, subject to the valuation filter. So our portfolios are more consumer oriented sort of businesses, because we believe, again, the longer term theme is intact. Many products where the penetration level is less, the opportunity to grow is very significant. There is a shift which is happening because of higher compliance in the overall economy. So larger companies are becoming much bigger. And so I think consumer businesses, turnaround oriented sort of sectors, it's a combination across sectors. The portfolios have representation across almost all of the sectors.
Which sectors would you avoid?
So what I mentioned in terms of the investment framework, that you lead businesses with 15% return on capital employed, another say 13-15% growth. Any sector or stock which do not meet that filter will try to avoid, particularly if they're not generating cash or so. So our portfolios actually you would see have lesser or very few names, let's say in construction sector or some of these real estate businesses also, because the cash flow metrics or the return on capital employed in many of these companies do not justify, or in some cases management do not justify the framework. So overall we are agnostic to sector. but we should it meet these set of filters of higher return on capital employed and higher growth.
What is your market outlook for FY21?
Now, the view is constructive. I mean, the Indian economy is going through, I mean, it's a tough phase in a situation where things would improve. And what is important is that the earnings growth will improve reasonably well on a lower base for multiple reasons. We're looking at almost 20% CAGR in earnings for 3 years, and this will be essentially driven by revival in many of the loss-making businesses or turnaround in businesses. We discussed on corporate banks, telecom, private capex. The base is literally zero. That would sort of improve, even healthcare. So some of these businesses will mean revert. So the profitability of them will improve. By the way, if you look at the profitability to GDP, I mean almost 1.3% negative contribution was happening. So that would turn to more positive number. That's sort of one factor. And second is the fact that we would see the positive impact of reforms, the positive impact of interest rate, which has been coming down in the economy. So I think the overall valuations are also reasonable. It's not very high, because PE multiples, when you look at 15 times 2 year forward, should be seen in the context that the earnings are depressed, the denominator is depressed, and second is the fact that interest rates both globally and in local markets have been soft. So overall, if the expectations are reasonable, let's say if investors are expecting about 13-15% sort of returns, NAV returns, and if the time frame is 3 to 5 years sort of thing, we think the outlook is fairly constructive.
The rally in the market has been very narrow. Do you believe there is a bubble in large caps?
So I don't know about bubble, but yeah, your observation is right that there has been rally which has been slightly polarized, and it's not that it's between large cap versus mid cap. Even within large caps, you have two set of buckets. There are set of companies or businesses where earning visibility is intact, which have, even in various challenging past sort of recent times, they have delivered good earnings because of the strength of the franchise, because of the character of the business or the management or so. There the market, a lot of money has gone into it, and probably the valuations have moved up. Some cases, could it be bubble? Yeah, I mean, there could be a bit of froth, but obviously not all companies are in the froth. So there is opportunity there, but one has to be selective. The other end of the spectrum is where you are getting very interesting opportunities. Here, these are set of businesses where earnings growth is patchy, has not been good in the past, although there is a potential to mean revert, whether it is metals, utilities, government entities, a lot of set of companies, even within large caps. So to that extent, we see this polarization. Actually, it's a very interesting time, because it gives a lot of opportunities to stock investor on a bottom-up basis to pick and choose from both the buckets here.
Given the current market conditions, what is your outlook on small and mid caps?
Basically, see, we think that the core allocation longer term should be in large or multi-cap sort of fund. Almost 3/4 of money should be invested there, because of these companies have a long way to go. India's growth is not sort of saturated. They have better return ratios, and in many cases there are better quality companies only in large caps. So for multiple reasons, a large amount of money should be invested in large caps, and it's not that they are very expensive. So to that extent, I think large caps are interesting. As far as mid caps are concerned, see, what has happened is there was froth in the market 2 years back. Same time 2 years back, January 2018, the premium of mid cap over Nifty was about almost closer to 30-35%. That has come down to a discount of almost 15-20%. So that again would mean revert in some sense. And core mid cap allocation should always be there, because essentially what are you doing in mid caps? You're buying it a bit early so that the earnings growth is higher, and generally it is accompanied by PE expansion. So the view is that one should have, say, about 70-75% in large caps and 25-30% in mid caps. So while mid caps may be momentarily more cheaper, but it should not have disproportionate allocation.
Could you share your key investment learnings?
No, so as a team, team, we keep on sort of looking at the past and look at various type of errors. I think we have two types of errors of omission and errors of commission. What is missed is also an error. And one of the learnings, of course, has been that not to sell good franchise, good high growth sort of business at an early stage. I mean, there have been cases in our portfolios where we have sold some of the names. We bought it at the right time, but we have sold it a bit early. So that is among the various learning, one of the learnings.